Thanks for joining us today. We got a really great crew up here, a blended user panel, as I would describe. Quickly about myself as director of CeFi at Chainlink Labs. Predominantly over the course of this year, have focused on strategic partnerships and user development in our centralized finance realm. For years, I come from the DeFi side of things, and this is why I really am excited about today's panel, because we both have DeFi and CeFi users up here today. We'll get into what product offerings that they're utilizing and their services. And so really, we'll dive into how CeFi and DeFi are coming together to really create scaling the forefront of finance today. So with that, Ermin, please introduce yourself.
Yeah, sure. So yeah, my name is Ermin. Prior to dHEDGE, I co-founded a fintech startup. And the backbone of this startup was a traditional retail fund registered in Australia. And I knew it was going to be hard to get it up and running. I just didn't realize just how bad it was. It took a long time. It was expensive, to the point where, if you wanted to start one of these funds, you need at least $10 million under management just to get going and not get eaten up by the fees. So this whole thing just seemed completely ridiculous to me. By that stage, I'd already been dabbling with Ethereum smart contracts. So when the idea of dHEDGE came along to do essentially on-chain hedge funds or vaults that anyone can start and operate at next to no cost using smart contracts, it just made complete sense. So yeah, we've scaled. We started off on Ethereum. We moved to Polygon and Optimism. We've crossed over $1 billion in trades, and we're scaling with Chainlink price feeds as well. And we also saw an opportunity in derivatives, so we've expanded a new brand, Taurus Finance, with automated vault strategies. And yeah, here we are, and it's a pleasure to be here and looking forward to the discussion.
Very nice, thank you. Cory?
Thanks. Cory, Pugh, BridgeTower Capital. We have been around about 3 years in the space. We are a company that builds marketplaces, very focused on institutional products. Investment banks coming into, I guess, what we would call Web 2.5. So Web 2.0 today, Web 3, and we're crossing that bridge. So we'll create products anywhere from staking. We've got 7,500 of our own nodes that we host on 100% renewable energy in Zurich. So from ETH to most of the layer ones on through. And then create products off of those. We create securities out of crypto and a marketplace that we can offer safe entry into investment banks and institutions to participate in the ecosystem. So we have offices in Singapore, Zurich, the US, opening Japan, London, and then Latin America.
Perfect, thank you, Cory. And Rick?
Thanks. Yep, so hey, I'm Rick Pardoe from Liquity. I'm the co-founder and lead engineer. And Liquity is, Liquity the company creates decentralized DeFi products. And Liquity the protocol is a system on Ethereum where users deposit Ether as collateral, and they borrow a native stablecoin, LUSD, against that collateral with no interest rates.
Fantastic, thank you. And before we get into it, we use a lot of words to describe ourselves, so let's see if we can cut through it. And if we could just go down the line, in one sentence, could you summarize your products and your services today for your org?
One sentence. This is harder than the elevator pitch. Vaults on steroids that anyone can start and operate at next to no cost. I didn't actually coin vaults on steroids. One of our core contributors did. So shout out to Jakey out there.
Very nice.
We're a regulated entity with a focus on creating institutional marketplaces for compliant products and services.
Very nice.
So Liquity is fully decentralized, borrowing interest-free against Ethereum.
Very good, very good. Thank you, gentlemen. Now, as we really get into the happenings of this year, it's really been a wild ride, as crypto always is, right? But we really want to use this panel to talk about innovation and pushing together through the frontier of finance. But just to take a step back, I think it's always important to start with first principles. And because the innovations that matter the most are the ones that last the longest, and because of all the wild experiments in the DeFi realm that we love to play and build together. Many have worked, but a lot have failed. So with that background and context setting, we could have this be an open question, so go ahead and kick it off, whoever. But to you guys, what has stood out to you that is the difference maker in the products that are truly built to last in this space?
Built to last. Maybe it's easier to pick out the ones that are not so much built to last. I think like from looking back even 2017, ICO era, there are typically two products with a lot of protocols. The core product, the thing that's supposed to be generating value for the protocol and generating revenue. And on the other hand, on the other side, we've got tokenomics. And like 2017, it was like no product, all tokenomics. And those that were around realized that didn't end so well. And then around 2020, DeFi summer, and we had products, but they didn't really attract users. They didn't really find product market fit. And then what we realized we could do is use tokenomics as a tool to sort of feed users through something like liquidity mining. So that's great, for a DEX that doesn't have any liquidity and no trades. You can bootstrap liquidity and get that network effect going. The problem is that a lot of protocols ended up really overpaying by a lot to sort of give this idea of or illusion of product market fit, to the point where there were DEXs that for every $1 they spent on liquidity mining, they would get back like 10 cents maximum or less back in protocol revenue. And they're the ones that actually would have activated protocol revenue from their trades. So they actually would have been better off just selling their tokens on market rather than doing this. And then on the other side, what's built to last are products that really don't rely on those tokenomics, but really have that core product that's an order of magnitude better than others. And one example for me is Uniswap v3. No incentives whatsoever. They just have a really good product that's better than the competition. And for me, these are secure, highly audited products, and I think that's what's built to last.
Yeah, a nice blending between the fun stuff and the stuff that's actually meaningful. So product and tokenization. Really great take. Cory, what are your thoughts here?
Great comments. ICOs, all the rest. I think for us, it's the regulatory landscape. You look at that, and we get to attend a lot of the Layer 1 conferences, which is very neat, because you meet a lot of the up-and-coming companies, established companies that are really doing a lot of amazing things. I think there's a few fundamental principles for us as we, 1, organize our company, 2, look at product, and then 3, look at distribution. And those all revolve around, would I be comfortable putting up my company, my offerings, and my distribution channels in front of the regulators? And if I'm not, then we don't touch it. So, and then the last one, which is very important, is can I commercialize it? Can I sell it? And finally, can I make money off of it? So as I look at what's happening right now, a bear market creates fight or flight. People are going to get nervous, and they're going to get desperate, so they're going to start doing things they probably shouldn't be doing. You're going to have good companies really hunker down and start to build infrastructure, engage with the broader communities, and start to figure out, how do I offer something that I want to do, but I may not have a license? I mean, what you guys are doing is pretty cool. I mean, that's a tricky space. We try to create securities out of crypto. Well, I need partners. I need an SEC transfer agent, or I need FINRA in Switzerland or whatever. So partnering with those groups today. So for us right now, it's infrastructure build again. We double back down, we build infrastructure, we get prepared, we work with the regulators, then we try to come up with compliant product, and we try to do it on a global basis. And that's the other piece. The blockchain can go anywhere, and that's the beauty, that's the risk. There's still jurisdictional rules as you're selling cross-border. You've got SERPTA taxes, you've got withholding taxes, you've got jurisdictional issues with the company structure. These are off the radar of a lot of companies, and so for us, those are the final things. And the last thing is, we run our company with no debt. We don't leverage it, we won't leverage it, we pay cash. If we can't afford it, we don't do it. And I think in a bear market, what I'm seeing is valuations, right? Last year, we're up here. And now they're down here. And companies are struggling with that. Funds that invested are getting hit. So I think you're going to get scrutinized even more today than ever, because now money matters. People are taking losses. We're not quite sure where the market's going. It's time to be a little more safe with the regulators than compliance.
Yeah, that is a really great point. And to me, this all means a focus in risk aversion is ultimately what allows you to not only do well in good times, but also survive through the bad. So very, very great take. And then lastly, Rick, what are your thoughts here?
Yeah, so I think the projects that really have been proven to built to last are they prioritize security and a robust economic design. So, in terms of security, they have a kind of defensive engineering mindset. So that partly involves layers of testing. So unit tests, of course, but also positive and negative tests, fuzz testing, mutation testing, and then also just kind of being paranoid about all the things that could go wrong, and kind of building a system in a way that is designed to mitigate that. So, considering worst case scenarios, attack costs, and kind of just that defensive engineering mindset. And then, of course, the projects that survive tend to have multiple audits, and often that involves audits from firms with different strengths. So, you may want to get an audit from a firm that's very good with kind of automated fuzzing and finding that kind of line of solidity code with an arithmetic bug. But then you might also get an audit from a firm that's very good at cryptoeconomic analysis and looking at kind of flash loan attacks or pool manipulations. And if you do that, I think you kind of cover more of a attack surface area. And then the final thing would be a robust economic design. So actually having a system that on paper makes sense economically. Obviously that's upfront design as well as kind of economic modeling and stress testing to kind of find the points where the system breaks.
Yeah.
Chime in on that real quick.
Yeah, please.
You said something that's key, and I think a lot of people are afraid of it, getting audited. I mean, from your books to your tech to your smart contracts. I mean, we partnered up with Chainlink, because in our marketplace, I don't want to touch the money. I don't want to touch the funds.
Okay.
I want a custodian. I want my clients to know there's safety. And so we have one of Chainlink's proof of reserves, which is out there, that hits all the wallets, sees all the transactions, and that kind of transparency, if companies don't have that, distrust automatically. So I think if you're willing to open it and show it, it's a key. So
No, yeah, that's a great add-on, and really it goes back to that risk aversion. It seems to be highlighted in your mind, Rick, the approach of security in the actual infrastructure and the products that you're offering, and then additionally the transparency that would offer folks such as the regulators. So really do appreciate those thoughts, guys. I really want to push this one directly towards dHEDGE and Liquity. But let's dig in a little bit deeper to risk aversion on the security level, more specifically to ultra reliable pricing data, and why is this essential, and what has it allowed you to build?
Right. I mean, for dHEDGE and Taurus vaults, or really any DeFi vaults, if you're depositing funds into it, typically you'll deposit your funds and you'll get back a token which represents a share of your vault. And on the surface that all seems great, but underneath you want to make sure that the number of shares you get and how those assets are priced inside the vault is super important, and you want to make sure that's done securely. So for us, Chainlink has done that, helped us do that for a couple of years. And on top of that, you really want to make sure you're using the best smart contract security practices. Because now these on-chain derivatives are starting to get more complex. For example, how do you price an LP token? And we've seen in this life cycle with some pretty high-profile hacks, the wrong way to do it and there's the right way to do it. And you can do that alongside with Chainlink price feeds. So, for dHEDGE and Taurus, it means that, anyone can deposit, anyone can withdraw 24/7 anytime, and we can be secured.
Very good. And Rick, what does this mean for Liquity?
Yeah, I think for us, we have very thin margins in the system. So, the minimum collateral ratio for a loan in Liquity is 110%. So that means there's only kind of that 10% difference between being over collateralized and under collateralized on an individual loan level anyway. So for that reason, we need very accurate pricing and very current pricing. The system needs to see basically the current ETH price, with as little delay or lag in it as possible. And And if it doesn't, then that can mean the difference between a liquidation being profitable or not. And on a system health level, kind of like a global system level, that can make the difference between being insolvent or not in a time of very high ether price volatility. And it also matters for the actual stability of our stablecoin, LUSD. So if there's a lag in ETH price, because LUSD is fully redeemable for ether, then actually it could open up a kind of artificial arbitrage opportunity that we wouldn't want to see in the system. So that very current price is really important.
Yeah, that makes a lot of sense, and that's why one of our primary focuses at Chainlink is security-driven product offerings, because we understand that ingesting a bad data point at any given time at the protocol level is absolutely, can be absolutely fatal, or enable the actual success of the protocol itself. So now I'm going to kind of direct this one directly to you, Cory, with BridgeTower. Now, looking at this from the CeFi perspective and angle, your focus is on institutional plays, and we're really starting to see this become an uptick in the adoption and future of crypto. And it seems like we really need to approach this with a thoughtful balance between the guardrails of KYC and predictability in a product offering. So, could you maybe elaborate your view on this and how BridgeTower navigates these types of waters?
Yeah, so I think we look at ourselves like NEAR. So we spoke at the NEAR conference 2 weeks ago, and NEAR's positioning is Web 2.5, which we talked about. So for us, CeFi is what exists today. The difference with CeFi and DeFi, I think, is also the ecosystem, right? CeFi is traditionally one entity owns and controls everything, and it's this relationship. In a decentralized marketplace, you have more of an ecosystem participating together. So we wanted to create a marketplace where we had the best of both worlds. So the way we've done that is to create, obviously we do KYC. We're whitelisting wallets. We've got Chainlink to improve our reserves. We have a custodian. Circle's coming in doing USDC off-ramp with fiat. And then we have secondary trading. Now, in theory, the bigger I can make that pool, the more powerful it is. Interoperability is something we talk about a lot, and interoperability gets a little risky because now I'm bridging different chains. With Avalanche, we launch a product here. It's a staked security that's EVM compatible. So now where it's a little CeFi ecosystem, I can take out to any of these Ethereum-based. So our angle was, how can we create a safe marketplace that's not too restrictive? And one other piece is we create our own product, but then we want others to bring their product in. So you talk to the GSRs, the Galaxies, on and on you go. Well, they want product in this marketplace as well. So I think as we look at, Switzerland has needs. The US has needs. You look at these different regions, and it's one marketplace, but we can target each of those areas with different products, with different things. We also are very keen on less is more. We're not trying to blast this thing with volume. We're not going to keep up. We're not a Uniswap and the rest. Yeah. It's a handful of products. They're very meaningful. But again, I think the interoperability between different protocols is an opportunity we're keen on. Of course. Because now we have more traction. So I guess we look at ourselves as a little more of a hybrid.
Of course. Yeah, using the powers of DeFi or decentralization to improve your product offering at the CeFi level is really enticing for me to see, and I think is one step closer to further mass adoption. So really, really happy to see that. Now, we'd like to kind of pivot to more pushing forward to the future and the innovations that are taking place right now in the frontier of finance. So we'll start with dHEDGE, and what does being a decentralized hedge fund on Ethereum? You talked about some vaults, and how does that uniquely unlock for comparative to what traditional hedge funds can't do?
Right. I don't want to bag out traditional hedge funds too much. And I think they're great. You could probably lump it together with traditional financial products in general. And when you deposit your funds into a traditional financial product or a fintech app, once you give those funds away, you give away your custody of those funds, and it's typically a black box, you know, what happens behind the scenes. And usually it's all good, but, you know, sometimes it's just really not. And we've seen it this cycle, you know, 3AC, you know, funds could be over-leveraged to the gills, and no one's going to know about it until it's too late. Celsius, you know, users' funds could be misappropriated, and again, no one's going to know until it's too late. And even in the most reputable, you know, traditional financial services companies and the most reputable jurisdictions, you can still have problems. And one example is Wirecard, a payments processor out of Germany, $3 billion just missing off their books, right? Insolvent basically overnight. And the crazy thing for me about this is, you know, months before, they had an audit from a reputable global auditor who sort of checked the books and said, everything's fine, nothing to worry about, it's all good. A few months later, gone. So DeFi just kind of flips this completely upside down and says, okay, no, no creative accounting. All the accounting is done on-chain, on smart contracts. You know, everything is above board, everything is transparent and open and can be audited by basically anyone at any point in time. And I think this is like the key difference between just CeFi and DeFi in general.
Very good. Yeah, great point. And you know, to maybe follow up on that, what does this mean for our builders in the audience today, and what else can be, you know, improved upon using this model, like improving in traditional structures? Specifically, how does Chainlink help?
Yeah, right. Yeah, I think like even today, there's just a lot of opportunities. Even if you look at, let's say you want to transfer money, you know, across the globe, and I think like for me today, the easiest, the fastest, most efficient, cheapest way to do that today is sending something like LUSD. It literally settles in seconds, and it costs next to nothing. So for me, I think we still haven't fully explored those opportunities, and you know, Chainlink has enabled, you know, US dollar as a real-world asset, and it's pricing all these other assets. I think bringing more of those real-world assets on chain is just going to unlock more and more opportunities.
Really good. Thank you. All right, now we'll go back over to Rick with Liquity. Let's talk about collateralized debt positions. These are enormous unlock, uniquely enabled by crypto. You know, what does this mean for you at Liquity, and you know, what are your thoughts on these type of products?
Yeah, so collateralized debt position is kind of the core of the Liquity offering, and it's basically, it was pioneered originally by MakerDAO a few years ago, and it's essentially a way for somebody to deposit collateral, in our case Ether, and then borrow a stable asset against their collateral, and it's single-sided borrowing, so it's like, you know, there's no lender per se in this situation. It's actually, you're borrowing directly from the smart contracts, the system itself, which is minting the stablecoin, LUSD. And yeah, the benefit for the user is, you know, they can get liquidity against their volatile assets that they have a long position on. So they're betting on Ether in the long term, probably, but they want to, you know, have liquidity to pay expenses or, you know, finance a purchase in the meantime, like a house or a car, something like that. And the advantage of doing it all on chain is it's kind of very neutral, and everything's transparent, and it's permissionless as well. So all you need is a bunch of Ether and an Ethereum address to be able to actually borrow against it.
Awesome, thank you. Now, following up on that, have you made a new financial primitive, and is this like new money Legos, or, you know, kind of dive into what you're building on top of that, and, you know, how does this help scale DeFi infrastructure?
Yeah, yeah, I think it is a new money Lego, like the CDP structure in general. I think what we've done is we've kind of done it in a way that's more efficient with lower minimum collateral ratio, and it's zero interest rates. And then, yeah, like I think in terms of integrations and what you can build with it, so you can do off-chain and on-chain integrations. One cool on-chain integration we've seen was with DeFi Saver, who basically do like automatic loan management on your behalf. So you can like set stop losses if you have like a sort of minimum threshold for, or a maximum risk threshold, and they will automatically like close your loan if it gets to that level. So you actually can pretty much always avoid being liquidated. And then, yeah, in terms of like CeFi integrations, we have a partnership with Bitcoin Swiss, who are basically offering Liquity loans as to their clients, but with fiat as the borrowed currency. So they're kind of abstracting away the sale of the LUSD for fiat, and that appeals to maybe institutions who want to go through a regulated entity rather than like interact directly with smart contracts.
Makes a lot of sense. Thank you, Rick. Cory, we've touched on proof of reserve briefly, but we're currently working together on facilitating your staked rewards tokens. Now, could you talk about what this is going to mean for your users, and why is this important? Why does this even matter for your offering?
So this started back in November last year. We were in a room with the global head of Nomura, EU head of SoftBank, Brevin Howard, and Galaxy Digital. And one of the things that we were talking about was how do we get access to these banks? This last week we talked to State Street, 47 trillion. And it's like they can't just come in here. It's not going to work. So we started looking at this and thinking about, all right, what can we do? And how can we bridge a gap so that these institutions can come in? Because there's phenomenal plays going on and opportunities. So that started the genesis of what do they need? Well, they can, most of them, take money off the balance sheet and or for their customers and invest in a security. So is there a way to take a security and tie it with the underlying crypto? So we came up with a product that we have, it's about 8,000 total of our own nodes that we host a lot of different, or we stake a lot of different tokens on. So we went with Securitized and Avalanche. We built it in a subnet. We used Avalanche and SEC regulator transfer agent, and we said, all right, look, let's take this staked ABOX. We own it. It's our nodes. You mint it on the ABOX C chain, and we're going to make it a security. Now that security has to be handled by a regulator, which we use securitized markets. We can use Swiss Stock Exchange. I can use SBI, who we work with a lot, who just got a license in Japan. So we thought about that and we said, okay, how do you put the mechanics together? And it's taken us 12 months to build it. But essentially, there's a few key components with that. One, you have to own the asset. Two, the smart contracts have to be bulletproof. We've got to have a regulated SEC agent who can sell the security. Though when you buy the security, you then go to our custodian who holds a wallet for you, and you now receive the rewards from that staked token. So you got a one-to-one relationship. So I've got a security token. Now I'm receiving the rewards from the staked ABOX. That product right there, I don't know, Marcus is over here. We got, I think, laughed out of 1 million rooms in the last year, which is kind of fun. And this thing will launch in 4 weeks. But it really was an opportunity, again, with proof of reserves. Money's a big deal right now. I mean, it's always a big deal, but you guys talked about it, and we're not a fund. I like funds. I've done funds, but I won't touch funds in this market because it's going like this, and I don't want exposure. So these products are all capital market products where the price is going to vary, and if the appreciation goes and it's a good product, you're going to have a beneficial outlay. But as we looked at that, this is where we use proof of reserves. I don't hold the money that comes into the product. I don't hold the money that is on my nodes, and I don't pay it out to the beneficiaries of this. Now, there still needs to be a check and balance. The proof of reserve hits these wallets, hits the assets, and in our dashboard, you can see a real-time auditing, complete transparency of where everything is at all times. So now you've really taken the first product, and then it was kind of cool. We were with the, like I said, the head of global product for State Street, and he said that's the first product we could actually invest in as a security. But it was a genesis, and going back to the point, I mean, there were 4 powerhouse trillion-dollar investment banks involved in the construction of that, and there's 5 big partners in it, Chainlink being one of them, to construct it. So getting an ecosystem involved and getting them to put the things together, and I would say, I don't know how many law firms, and a few Deloitte law firms, right, tax firms, so.
What a perfect use case and example setting, not only in the CeFi to DeFi markets, but utilization of proof of reserve for real-time transparency. Phenomenal use case there. So very, very excited to be working with you there. And then to kind of just follow up once again, you have a very large presence on Avalanche. Tell us about your stake product offerings, anything that you've missed so far.
So the stake security is running down, well, we're starting with securitized markets, but then there's multiple regulated exchanges that can take it. We built our own, we used a great firm, Idisoft. They built multiple, well, actually with Near and Solana right now, building out their chain. They built some securitized a stack. We use an Avalanche subnet, so we build our own marketplace in the subnet, and we have, staking. There's some wonderful staking companies, Blockdaemon and Figment. We thought, what if we offer that same process in an end-to-end solution? Same thing as a stake security. So you look at a Lido. We have a lot, 6,000 ETH nodes on 100% renewable energy with that relationship. Andreessen comes into Lido, and they say, look, we want to have an institutional gateway, meaning we need a little more transparency. So we partner up with them. This will come out, announcement in a few weeks, and they will run their institutional staking arm through our marketplace.
Wow.
And now you've got institutions who really want in ETH and staking and the DAO concepts, but they need to know where it's at. So,
Fantastic. Yeah, no, fantastic to hear that you're working with Lido, and many of us here are huge fans of that offering as well. So, as we get kind of towards the tail end of today's conversation, let's just have some open, questions. So I'm just going to toss these up to the crowd, and you guys, here at the panel, go ahead and give it a shot. So, what do you see as core building blocks for crypto today, and that will power the next wave of products? More specifically, what are we going to see in DeFi in the next 5 years, 10 years? What do you think?
5 or 10 years. Let's try 3 months.
We'll start 6 months. Yeah. There we go.
Yeah. For core building blocks, we can look at, again, towards the tail end of the last cycle, what are some of the blocks that are coming up and what might be feeding through to the next one. Just as Cory said, volatility is something that nobody really likes, especially the large drawdowns. And if you talk to just a regular person or a crypto outsider, you ask them about crypto, and they're like, oh, the volatility, they're just, people don't want this type of exposure a lot of the time. So I think some of the on-chain vaults that we've seen come up, the last generation of on-chain vaults, really try and dampen that volatility, using, you can use options, for example. We're about to integrate Lyra options. So, or delta neutral strategies, just your stock standard, liquidity mining on stable coins isn't going to cut it. It's just inflationary. You want stable yields and more complex strategies using lending, borrowing, LPing, and all the rest of the DeFi tools, combining them really together into a single product that's packaged that gives where people can actually choose what sort of exposure they want to volatility. So you can imagine, you buy ETH, you ride it up to 4K, you ride it all the way down. Or what if, at 4K, you have a put option on ETH that's completely on-chain, transparent, so you don't eat those losses on the way down. It's like an insurance policy. And this is what we're looking to build with Taurus Finance.
No, I really like that. Have a derivatives background, so
real
I really
quick,
appreciate that. Cory.
Here's the elephant in the room, liquidity.
Yeah.
Right? We all want liquidity. So, DeFi, CeFi, call it what you want. I think everybody's trying to find an ecosystem or an environment whereby you have liquidity. Otherwise, this starts to become a problem, which we're seeing, which we won't get off into that, and I think there's more hits to come. But for us, good products, good projects, in a marketplace, whether you want to be decentralized, define it as the globe or define it as a refined environment. Our goal is to absolutely have DeFi. But I want it in an absolutely regulated marketplace where it's created by meaningful products that are having serious volume. And now you've got it in an ecosystem that's got all these checks and balances. So I think DeFi is a huge opportunity. I just think, we have attorneys that are working with the SEC all the time. These regulated KYCs, proof of funds, securities, those are not going away. And I think people are ignoring those in the lending and the DeFi, and which we're all in for. But my personal opinion is it's going to come down to who can play the game with great product, great companies like these guys, and who can get along with the regulators and pass their tests.
I love it. And then, Rick, any thoughts here that you want to add?
Yeah, I think one of the core building blocks currently and going forward is stablecoins. It has to be. It's just such massive demand for holding and borrowing and trading stablecoins. I think currently we've not seen a stablecoin project that's kind of broken this like stablecoin trilemma, right? So it's the idea that you can only get 2 of 3 really important qualities with a stablecoin, and like so you want decentralization, stability, and scalability. But yeah, we've not seen anyone who's done all three, right? They've only managed to get 2. So if you think of like a fiat-backed stablecoin that sacrifices decentralization, like collateral-backed stablecoins, they struggle with scalability because you have to match the borrow demand to the stablecoin demand. So I think going forward, it doesn't mean it's impossible, right? Like maybe that can be solved in future. And
Yeah, and ideally they're using proof of reserve to help balance those inequities there. So, all right, I think this may be towards the tail end or our final conversation, but we'll just throw it up anyway. As we move into the future, how do we see the distinction between CeFi and DeFi evolving, or are we seeing a distinction, or are we going to see the lines blur a little bit more?
I think there's going to be a distinction. One thing that comes to mind, I recently got to listen in on a university MBA lecture on crypto, right? This is supposed to be one of the top universities in Australia. Let's tell us all about crypto and teach the MBAs about crypto. And what stood out to me and what surprised me is there were really just only 3 main topics discussed. Bitcoin, proof of work, for some reason going to the nth degree about how proof of work works and whatnot, and NFTs. There wasn't a single mention of DeFi, not one. There was one slide on smart contracts, and let's move on. So kind of what this showed me is that DeFi is really just invisible. And it's not getting simpler, it's getting more and more complex as time goes on. So I'm really buying into this narrative, and I think Sergey talked about this yesterday, where DeFi is really the back end, becoming the back end of the financial system. And I think we will see these traditional financial services apps and fintech apps that are going to be tapping into that value as the more user fronts for these products. So I think this feels like where things are going.
Good take. Gentlemen, Cory, Rick, what do you feel?
Yeah, I'd like to see like DeFi remain pure and kind of like made up of these decentralized, immutable building blocks that can then be used by CeFi in however it is needed, right? So they can add in better UX or aggregate them or put in points of centralization if needed for their own clients. But I think DeFi hopefully will keep the focus on the pure, neutral, decentralized building blocks, rather than integrate too much of the CeFi points of control, because it's a different layer, I think.
Yeah, and I do appreciate that take, and not to put too much highlighter on you, Cory, but I almost feel like you probably have a slightly different take on this.
Yeah, very much.
Yeah. Please.
No offense.
Yeah.
I think those of us who have been a little around long enough lived 2008. We've lived these markets. This is a global play right now. I mean, the whole markets are getting hit, and it's funny to me how somebody mentioned, this whole premise of crypto's a deflationary hedge against the markets. I don't buy that for a second. I mean, money's money. It's coming in and out. CeFi and DeFi, it depends on who you want to play with. If you want to play with retail investors, fine. I think DeFi's there. If you want investment banks and institutions and money, there has to be a blend. Because they have charters, there's rules, and there's a reason. And those of us who have lived long enough to go through what happened with the internet and how the regulators hit that, and then you get into 2008 and the markets crash, you have to have some kind of transparency and you have to have some kind of openness. So I think they can both exist. I personally think they're going to mesh, because I don't think the regulators long term are going to let them not mesh. Now, if there's some way to create a hybrid, which is kind of what we're trying to do, then I like it. But I guess for me, it depends on what kind of money you want and who's going to come in, and can you look the regulators in the eye. And
I really do appreciate that. I appreciate everyone's take on the stage. Just for fun, last few seconds here, my 2 bits on this topic is, it really boils down to the power of choice and encouraging more freedom globally, specific to financial markets. So ultimately, I don't see a winner-take-all situation. I see some instances of standalone CeFi, standalone DeFi blending, but ultimately, as users become more educated and have access to a broader amount of options, I think this is kind of the ultimate future, at least from my take, my perspective. But you know, Rick, Cory, Ermin, thank you for your time today. I had such a great time moderating this panel, and yeah, thank you.
Thank you.
Thank you.